Okay. Good evening, everyone. I think we can now start. It's a pleasure and an honor to be here with you people, and welcome to our investment trends in 22 and beyond webinar. My name is Teddy Mudhoka. I'll be your moderator for the day, and our guest today is Mr. Paul Gicheru. Our session will take place for the next 1 hour, 30 minutes, so we do promise to keep time. And we have a lot in store. We have a lot in store for you guys. And before I invite my host, allow me to also talk about Mantalk Worldwide, who are the kind facilitators for this event, which is under Mr. Zeph Onditi. And it's a pleasure to have him bring each and every one of us together under this platform that we may be able to learn together. So today we have a lot in store for you guys, and our major outline for today is as follows. We'll have a brief introduction of who Mr. Paul Gicheru is, and then he'll take us through a brief walkthrough. And we'll also have a Q&A session, which is going to be quite extensive. So if you do have any questions, please feel free to throw them into the chat box, and we'll be more than glad to respond to them and any other comment or suggestion that you may have during the session. And then towards the end, we'll also have a Q&A session with the audience, where we'll have each and every one of you guys join in and just get to ask questions, which we'll be glad to respond to. Allow me to introduce myself again. My name is Teddy Mudhoka. I'm the founder of Finances Africa. And Finances Africa is a startup that is aimed at simplifying financial education for young adults in Kenya. And allow me to introduce our guest today, Mr. Paul Gicheru, who is the Executive Director and Chief Investment Officer at NCBA Group. He has an experience spanning all the way from as far as 2006, starting from PricewaterhouseCoopers, moving on to Close Brothers Cayman Limited, PKF Consulting, and joining Commercial Bank of Africa in 2011, where he started out as a senior manager under corporate finance, and went up the ranks as a senior investment manager, chief investment officer of the CBA Group, and after the merger with NIC Bank, became the executive director and chief investment officer. And it's a pleasure to have him here with us. He has a wealth of knowledge that he desires to share with us. And I know he'll do much more justice to his introduction, as he definitely has much more to share with us. So allow me to invite you, Mr. Paul, And take it away. We are more than ready to hear from you today.
Good evening, Teddy, and good evening, everyone. It's indeed a pleasure to actually be here today. I think every time I hear the introduction from anyone else, I'm always checking whether there's another person sitting behind me. It's always very, very exciting and rosy. But in a nutshell, my name's as given by Teddy. I work at NCBA Investment Bank, and we are providing asset management or wealth management solutions to our clients. So if there's anything that then gives me a lot of pleasure is to actually be sitting in sessions that we are talking about investments and talking about, what can actually take us to the next level as far as investments are concerned. So it's an area that I'm very passionate about. It's an area that I work with my clients on, and I'm really looking forward to an engaging session here to sort of, help demystify some of these things that all of us will be thinking about as far as investments are concerned. As I always say about these sessions, we never do these sessions to impart any new body of knowledge, not at all. The idea is actually to package together what we all know, but give us some sense or underpinning process as to which you can actually use to apply some of the concepts that you know. And so that's what I look forward to doing in this session, and I truly hope it will be an interactive one and one that helps each of us attending. Thank you so much, Teddy.
You're welcome. So I believe you can start us off with a brief walkthrough on what it is you're going to discuss for the day. And then after that, we'll jump into the moderation session.
Good. I don't know about the rest of you. I happen to be in a very rainy place. So there's a lot of rain interference coming from outside, but hopefully we'll still be able to communicate and do so effectively. So in terms of what we're discussing today, Teddy gave me a very good brief as to what you want us to sort of go through today. And at the onset, we want to think about what mindset all of us ought to be in when thinking about investments. So talk about, at a high level, behavioral and, rational or, traditional finance thinking as to what kind of mindset all of us should be wearing when we are thinking about investments. And then once we're done with talking about the typical mindsets of an investor, we'll look at, the trends that have been over the last couple of, the last 2 years really, because I think we've probably gone through one of the trickiest times in history as far as financial markets are concerned, management finances are concerned. And so we will be trying to sort of internalize what the trends are or how they impact investments. And then after thinking about those trends and think about what investment opportunities are coming about out of these new trends. Once we are done with looking at those investment opportunities, we'll start to think high level about how you think you should think about then allocating your investments or your portfolio to make sure that you're extracting the best out of all these opportunities. And then we'll get into a question and answer session where then we can respond to any questions that you may, that any of us may have. So without further ado, I'll probably just get into a high level chat about the investor mindsets. And I mean, if you think about it, what is a mindset? Typically, what we call a mindset is our beliefs. And our beliefs are what really impacts how we carry ourselves, how we interact with others, how we think about markets, how about we think about risk, how we see everything tying together. And it is those beliefs that are so important that will make a difference between all of us who could have gone to school, all of us could not have gone to school, but make different decisions. Because there's that belief system that was probably imparted in you very early in life, and that's what drives you. There's that belief system that has come because of the people you interact with, which is we call your environment. That's what drives you. There is that belief that then you got out of the training that you got in school, and that keeps driving you. And those are the matters that then, at the end of the day, determines how well we invest, how well we avoid risk, and how well we think about, about investments. Now, there's a whole, school of finance called behavioral finance, And one concept that behavioral finance have been trying to decode is a concept called, the self-control trap. What is a self-control trap? Self-control trap is an inherent issue that we have as human beings to actually struggle to relate to very long-term objectives. And so what happens is everything that we try to do is built around objectives that are very near term, objectives that I can almost touch. They are tomorrow's objective, they're next week's objectives. We inherently struggle with relating to the long-term, very long-term views. And what that then that does is actually to even restrict the way we interact with the markets, the way we interact with the economies, and the way we assimilate information that's actually coming to the market. And the general drive to this is, I think, human minds generally hates ambiguity. So we'd rather be in more predictable environments, or things that we really can say this is the direction we'll go, than being in situations where we cannot deal with ambiguity. Now think about it. If I have to think about my next 30 years, I mean, beyond 5 years is so ambiguous. I mean, for a Kenyan, election is important. For a young person, but the bringing up of kids is important. And so when you start thinking about those elements, start introducing ambiguity in life, and that starts affecting how you perceive investments and how you look at investments. And I'll be trying to look at a number of things that we should actually be thinking about when we are thinking about the investment journey, so that even as we struggle with short-term mindedness as a human race, then we can also start, putting things into context, even as we think about our investment journeys. So one item that, I'll probably just want to us to reflect on is the whole notion about, getting rich quick. It's either today or tomorrow at the latest. Now, that very notion has actually impacted in a big way how we choose investments. And so I want to go to an investment which could be very speculative in nature, if we call them investments, with the hope that tomorrow I'll wake up very rich. I'll go for rotaries because I believe from rotaries I can actually get rich tomorrow. And what that is doing is to actually sway us or get us out of the mindset of actually making very good and long-term investment decisions. I think the message I'll be trying to give here is it's time to actually start convincing ourselves that investing is a process. And investments actually do take time before they can actually flourish. So the notion that I can actually get into an investment today and in 3 days' time or a few weeks' time, I'm actually speaking large about the kind of returns I'm making is actually something we need to dissuade ourselves, especially as we look at an increasingly volatile market that's actually being influenced by new developments, new factors every day. So one item I would say, let's start looking at investments as long-term. Let's believe, or rather, let's internalize that investments always take time to actually give the fruits that we're looking for. That's the item number one I'll actually want us to take very seriously. So whichever investment you're looking at, reflect on what are the characteristics and how long does it actually take before it can show me a return. Second item is that, and I think these were reminded many years ago, if you don't plan, then you are planning to fail. If you don't operate with a goal, then any investment will take you there, including no investment. So some of us will want to get our money and spend it today because we are not thinking about tomorrow. So one important thing is to actually always internalize and think, what exactly am I getting into investing for? What exactly is the end outcome I'm actually seeking to achieve? Without an end outcome in mind, you'll probably not start the journey. And if you start the journey, you probably abandon it along the way. And if you start the journey, if you don't abandon it away, then a lot of distractions will come your way. And what you realize that if you had said, okay, I want to develop this side hustle to become this big, by year 3, you've changed your mindset because a risk came your way, something happened your way. You were not specific as to the goal you're trying to achieve. So it needs to sit at the back of our minds that we need to have realistic long-term goals. And then those long-term goals then can be reduced into more granular, shorter-term interventions that actually lead you in that direction. Unless you do that, then you'd probably not get where you want to be. So my goal, for example, is to retire comfortably. I'm getting very close to retirement. To retire comfortably, then I have to start thinking, how many years do I have to work? What kind of investments do I need to set up now that can give me that decent retirement? What do I need to do in 5 years, 10 years, 15 years until I get to retirement? And how will I then dispose my assets so that at the time of retirement that I'm actually getting cash flows from that assets, linking short term to the long term. The other thing is to remind us that is actually there's a method to the investment madness. I think one of the reasons that we all lose money is because we jump onto anything. So people are buying people are buying cryptocurrencies, we're all jumping into cryptocurrencies. People are buying infrastructure bonds, we all jump into infrastructure bonds. People are starting side hustles, we all jump into side hustles. What that does is, unfortunately, because of that, we are not doing adequate research as to the investments that we are going into. And we are also not exerting ourselves to really ask ourselves questions. How does this particular investment, fit into my long-term goal? How long does it fit, or rather, how does it fit to what I want to achieve over long term? So what I'm challenging us here is that as you start thinking about investment, then invest in research. Invest in research that will tell you this is a good direction to go because it's a good fit, and I understand the underlying, and that underlying speaks to the objectives that I'm actually trying to achieve. Do your own research and really value your research, because it's that hunch that research gives you that makes the difference between making a big loss or actually making a big gain. Then don't fall for what you call fads. Fads are, what, as I was talking about earlier, things that are fashionable. So what are people doing? What is trending? What are we heading to? And all that. And the problem with the fads, they just make us join herds. So we become like cows, and all of us are, being led to a grazing point. That grazing point, we may encounter, a hyena, we may encounter a lion, we probably find water, you never know. But what I'm trying to say here is you need to actually look for mechanisms of developing your own comfort around an investment and not listening to what everyone is saying. If you listen to what, for example, Paul will tell you, Paul will tell you, go and buy money market funds. And you ask yourself, what exactly was I trying to do with money market funds? But because you are following the herd that's going in that direction, then you end up buying an investment that was not a fit for you, for your long-term goals. Another item to highlight as far as the mindsets are concerned, we need to be risk averse, but should not fear risk. Now, the concept of risk aversion is something that we always discussed everywhere. Risk aversion speaks to taking risks when necessary. Now, taking risk when necessary means if I'm talking about investing, I'll only increase risk in my investments if that incremental risk will lead to an incremental return. So in essence, if I was putting my money for the purpose of taking my son to college 2 years from now, I'll first go for the first investment that will assure me that that money will be available. I will only go for the next layer investment if I believe, based on evaluation of risk, that there's an incremental return coming from that. I'm not saying fear risk, because it's that risk that will give the incremental return. But make sure that at the point of evaluation, then you're saying, okay, am I taking a risk that adds return, or a risk that I do understand, or a risk that may actually lead to me losing my money compared to the goal I was trying to achieve? This compared to a concept that then people call risk seeking. Now, risk seeking happens then, just to give an example, what happens with people when they're heading to retirement is you realize that at the age of 50, you've not saved for retirement. And then we go crazy because what you're trying to do is to catch up. And so I'll look for the next investment that I think in my mind can give me that incremental return. And so I'll be running up and down, looking for the highest risk seeking, with the hope that I'll catch up with the decisions I didn't make in the past. The problem with risk seeking without thinking about the risk return trade-off is that you end up taking a risk that then actually becomes counterproductive to the goal you're trying to achieve. So be risk averse, but do not fear risk. Ensure that every risk you take amounts to an incremental chance of making a higher rate of return. Don't place in your eggs in one basket. I think this one has been played out time in, time out. I think it's about diversifying. So if you have 1 million shillings as my saving kitting, I don't want to put that 1 million shillings in one asset, simply because an asset can burn for whatever reasons. As safe as it could be, it's always good to diversify. That's a mindset that we always have to wear as we are going to investments. Now, the other important thing is in terms of comparison of savings and investments, we save for the short term, we invest for the long term. So if you're looking to do some short-term objective, and I like calling short term here, anything below 1 year, then you actually need to put that in a saving vehicle. Saving vehicle means very low risk on your principal investment and manageable or predictable kind of return. But if you're thinking about long term, then you start thinking about combination of getting significant profits, capital gains, and enhanced rate of return for the kind of investments that you're making. And so that's when you take, your hustle as a long-term investment. That's when you take bonds as a long-term investment, or any other investment that you may be looking at. Then it's good and always important to be sure, even in the best laid investment, you should always expect bumpy rides. Bumpy rides could come in the form of changes in regulations. For example, you could have bought a money market fund, for example. The regulations change along the way that says the tax from that investment has moved from 10% to 20% or higher rate of return, higher rate of tax. Or you could be investing at a particular type of business and then something changes drastically in the market. Expect a bumpy ride. As much as you had really planned, be conscious that bumpy rides will arise each now and then, something that you need to be always conscious about. And then the last item here is that, the cost of failure is actually school fees to learning. So you only learn out of these failures. So you don't cease to try just because you have failed in the past, or you don't cease to try just because you fear that things may fail. So the challenge here is that whichever way you think, just keep trying, calculate your risks, ensure that you appreciate what you are going for. But in case it doesn't work, it is not the end of life. You've learned one more thing. By the time you're getting the next opportunity, then you actually are in the right type of mindset. If you put all these thoughts together, then they actually start preparing you for investing. They prepare you to, wear the right mindset. And from there, then you can start evaluating investments and deciding which direction to actually take your investment journey. And then from this, I can just walk us through, the key trends that have been happening over the last, year or two, or, the very recent period that are affecting investments. And what I've done here is to, categorize this show 3 categories. What's happening at the global front, what's happening in Africa, and what's happening in Kenya that may affect investments. And without overplaying it, I've just put on your screen some of the things that are really impacting investments right now. I think the main thing the last 2 years have actually been the issue of COVID. COVID has presented opportunities, new learnings, and a lot of risks as far as investing is concerned. But you agree with me that there are people who've actually come out very rich out of COVID, not because of they're doing, shenanigans or underhand deals, but they've actually identified opportunities and have ran with those opportunities. Being in the right industry, looking at the market correctly, and unveil a lot of opportunities that we hadn't thought about, prior to COVID. Then, of course, the markets have been very volatile over the last year or two. The volatility started with COVID. It was accelerated by the stimulation or the stimulus packages that the world rolled everywhere. And then after that, now we are living with the effects of those stimulus packages, with some economies failing to recover, economies recovering at different paces, and all that is causing a lot of jitters. But again, I always say, a crisis, never waste a good crisis. This is a good crisis that actually is creating opportunities that you wouldn't have thought about if this crisis did not happen. Then the other important thing that has been happening to the world is the strengthening of the US dollar. I think you probably have watched that, even against Kenyan shilling, the US dollar has strengthened a lot. This is being driven by the general, flight to safety world over. People are looking for investments that they think are way safer. And I think most of these will be USD denominated. And so that is actually impacting almost every global currency. A lot of loss as far as that is concerned, rising inflation in the rest of the globe. Those are either risks as far as investments are concerned or opportunities. And then central banks have actually gone, what we call hawkish. These are two central banks who are too concerned about inflation and so are looking for everything that can taper inflation. And that's why I said we created stimulus packages. We did not think about the global supply chain disruption, and so that has led to inflation the world over. And so everyone everywhere in the world is trying to manage inflation. I think with the exception of a country like China, everyone else is trying to manage inflation. And so those are the issues that are then causing a lot of upheaval as far as investments in the global space is concerned. China, I think this has, I mean, I cannot overplay this. I think we all know that China is doing a serious crackdown on tech industries and banking, real estate, and all that. It's talking about common prosperity, so taking back prosperity home and developing self-sufficiency. I think these are lessons they've picked, quite aptly from COVID, and I think every country has been trying to do that. So that's presenting new risks and opportunities as far as various markets are concerned. More recently, Russia and Ukraine, I think we are reading news every day. We don't know whether there's an invasion, there's an attack, a lot of terms coming about. But the biggest impact this is having is actually the impact on the global trade. I mean, we've seen the cost of oil, gas, and all that rising, and now starting to impact even further the inflation in the West. And of course, for the rest of us, when the West is actually in such a situation, then our situation just gets worse. So it's very important. Important here, commodity prices have been recovering. I think as economies reopen, the demand for commodities has really been rising. So you're talking about metal, you're talking about raw materials of any nature, including crop materials. That is rising. And I think that also presents good opportunities for countries in Africa, or us in Africa as investors, to actually try to see whether we can actually tap into that space as far as trading is concerned. I mean, look at the avocado market increasing every day. Derivatives of avocados, for example, rising. And I think for us in Kenya, that has become a conversation that you're having every so often. So which other products can you be looking at? I mean, can you look at the oil space? Can you look at vegetable space? There's a lot of opportunities there. I talked about flight to safety, so something that we need to be conscious about. That the reason you probably see volatility in our market is because everyone was investing here. If you look at the stock market, people have been pulling out money and looking to invest in the West, in stronger currencies, and that's causing a lot of volatility around the world market. Asset repricing is ongoing, simply because of the many factors I've been talking about. So, for example, the US stock market did very well 2020, 2021. But we've seen since January started, the US market has actually been losing, simply because the interest rates are rising in the US and people are not convinced that the stock market, for example, will perform very well. The bond market is also looking very bad because interest rates on bonds are rising. And so you're investing in a bond, the most likely thing is that the value of those bonds will actually come down. And that's happening even in Kenya. Then, of course, the other major development is what the crypto market has done to the whole market. Crypto market has changed the world perception about gold, for example. Gold was always the store of value in a crisis environment. Unfortunately, we've seen gold is not going anywhere because for a long time, people believed crypto then is the other alternative to managing inflation. But that has actually been challenged because the crypto market is also suffering an onslaught by regulators who wants to introduce regulations, create a more stable space as far as dealing with cryptos is concerned. So all these matters are actually coming, if you think about it, to present very good opportunities for you as an investor, or for someone who's actually looking out there, or for someone who's evaluating local risk versus risk elsewhere. But they also present challenges. What then this underscores is the value of doing your own research before thinking about every investment. So a few months ago, people were saying, okay, if you are going for cryptocurrency, go Bitcoin. Look, there's a whole world of other opportunities. There's a whole world of cryptocurrencies. So one has to decide which subsector of cryptocurrency do I want to go for? Am I looking NFTs? Am I looking at stable coins? Am I looking at meme coins? Am I looking, just deciding which space you actually want to be playing or which space you want to be researching and how it fits onto your overall game. If you think about Africa, then Africa probably the situation in 2022, 2023, 2024 is not too promising. I think we are still and will continue suffering from the post-pandemic effects. I think our economies were already beaten. Before they grow again, it will take some bit of time because we are still relying on, the IMFs who are coming with restrictions. We are still relying on support from other countries. We are still relying on, deferment of debt. So the opportunities actually are still very low as far as Africa is concerned. It doesn't help that, that also comes with a lot of, conflict, around Africa. Closer home is Ethiopia. We know what's happening in Ethiopia and how it's impacting investing in the whole of Eastern Africa and the perception of risk. I mean, the Sahel region, the Central Africa zone, the Burkina Faso, the Chad and all that, we own the crisis that's happening there. So all those things are presenting risks in Africa, more they're presenting opportunities. And so if one is looking at intra or rather African opportunities, then you probably have to, be very selective in what you're actually looking for. But having said that, then one has to be, I said earlier about recovery commodity prices. So there's certainly pockets of opportunities that, and I think that's probably what will also lead to Africa's recovery. Because of recovering commodity prices, then as an investor, you can actually decide which space you want to play. And it's more of thinking, where is the trend? Where are the world's trends going as far as consumption is concerned, production is concerned, industrialization is concerned, and all that? Where are the opportunities that I can actually start tapping into? Tapping into, commodity opportunities can be direct opportunities, or you can actually be looking at it as indirect, going to the futures market that is now available for us on, platforms, mobile platforms that you can actually start looking at. Of course, if you look, there are still opportunities to do with buying Eurobonds across Africa and, Eurobonds related funds. One can actually start looking at those opportunities. But be conscious about the political risk, the currency risk, and of course, always be keen to understand for each of the countries you're looking at, what is the economic situation that, that may impact the investments you're looking at. And then in Kenya, without belaboring it, I think number one is elections 2022. I think that will slow down Kenya for most of this year. But that doesn't mean there are no opportunities. I think one has to think about opportunities beyond electioneering. So if you're looking at the stock market, then can you think about beyond electioneering, because it offers good entry opportunities. If you're thinking about bond market, can you think about increasing for example, the coupons that you're earning or interest rates you're earning on those bonds, just to keep you cautioned? If you're thinking any other investments in Kenya, you have to think about this year. You have to have a reflection of what the elections are likely to do to it. Government spending, I think, has been what is leading the GDP growth. That's probably going to be constrained going forward because of the level of borrowing. So the question is how that impacts the GDP growth in 2024, 2023, 2024, and the years ahead. Something one has to be conscious about as you think about the next venture. Purchasing power has really been impacted. This is post-COVID and the fact that the economy is not recovering. So if you're for example, in a space that we're doing what we call consumer discretionary goods, those, luxury goods, cosmetics, those kind of things, then we can tell the market is actually shrinking because the people who hitherto could afford these products, their purchasing power has been impacted so much that they're not able to afford those products. So then as an investor, you have to think about how then you actually have to move between the cycles from one sector into another sector, because some sectors may take longer to recover and others may actually recover way faster. So if you think about, for example, consumer staples, those things that we must consume, food and all those kind of things, then those certainly will continue surviving. Think about, I keep talking about things like school uniforms. You probably not get it wrong on school uniforms. People are not even getting it wrong, for example, in children wear, because there are trends that are not necessarily shifting as much as purchasing power is actually being impacted. I talked about rising interest rates. I think we'll be in a high interest rate regime within the next two to 3 years. That will impact investments. That will impact how companies that you could be investing in are returning. That will also impact your business, because you may want to go and look for loans and all that. The cost of loans may likely be rising alongside the rising interest rates. Talked about currency risk. I think I don't overplay that. It's an important consideration, especially so if you're doing import business, or if you're interacting with the rest of the world, or then if you have to spend some bit of money in other currencies. I've talked about commodities, so I'll not belabor it. So out of all those, then all those risks economies are presenting, opportunities economies are presenting, then one asks, where are the opportunities for me as an investor? What should I be looking at as an investor? And so what I just thought is to actually talk about the various asset classes and where the opportunities sit within those asset classes. So locally, if you think about it, if you're starting with the stock market. Now, if you look at the prices that we have on the stock market, for almost all the counters, the stock market is actually oversold. That's the term we'll use. Oversold for us means people have sold their stock so much that the prices have come to levels that as much as they could be going down, they already offer very good entry opportunities. I mean, think about it. Look at all the banking stocks. Banks are likely to report very good returns this year, but the stocks are not recovering as such. If you look at the manufacturing sector, the EABL, the Bamburis and all those kind of things, the real estate sector is starting to recover. That may favor Bamburi. EABL, the economy is recovering. That may favor EABL, but the stocks are not recovering. If you look at what we call the entry multiple, so price to earning ratios and those, they are looking so good, creating opportunities for you to start thinking about investing in that sector. But the mindset that you have to wear is that investment will not probably yield fruits in the next 12 months and may not necessarily yield fruits in the next 18 months. I think the yielding of fruits as far as the stock market is concerned is a 3 to 5 years play. When it will recover strong because these companies are now starting to look, I mean, the fundamentals of these companies are starting to look very good. So if you're thinking about then investing for the long term, then start putting some bit of money on the local stock market and picking shares across different sectors. That will give you opportunity to make a very good return over time. And then, of course, if you're already invested, then start looking for ways of reducing your cost per unit down by buying now, so that when the recovery starts, then the overall holding cost that you'll have for each of these stocks will actually be the way lower as compared to what it would have been if you didn't participate. Then, of course, local stocks over US stock are a very big advantage as far as taxes are concerned. And I think for all of us who are young, tax consideration is a very important thing in every investment you look at. You need to look for the investment that really helps you in tax planning, reduce your tax burden. The stock market in Kenya, all the capital gains you make are not taxed. The dividends that you make are taxed at 5%. And so very moderate or very low, very low tax coming out of it. And so it's time to start thinking about that. If you cannot buy or don't have the presence of time and mind to actually buy stocks directly, there are enough equity funds in the market that you can give you an exposure to the stock market in small bits. So as low as 1,000 shillings, 2,000 shillings, you can start getting a diversified entry in the stock market. And then, of course, I mean, for the more creative and people who actually are more experimental, we have a derivative market or futures market that trades on the shares of Safaricom, KCB, and EABL. So giving you an opportunity to actually start putting very small investments, but making bets on some of these companies. In the developed market, and I talked about developed market because I know now from your phone you can actually start accessing some of the developed markets. Then the repricing that's going on across the globe, which the repricing is downward, gives you a good opportunity to start buying into some stocks, or buying into some what they call mutual funds that expose you to the developed world stock market. So it's you need to think about it. I need to get some bit of dollar exposure to diversify my currency risk. And that dollar exposure for me will come in the form of buying some stocks. And these stocks, I'm willing to actually hold them for the next 2 years to give me a meaningful rate of return. I'll get a double advantage here. I'll get the gain from those stocks, and I'll get the appreciation in the dollar because the general trend for the shilling for the next 2 years or the next couple of years is actually depreciation. So a good way of actually starting to mix and match various assets to actually give you, resilience, rather create resilience in your portfolio and put you in a better path as far as wealth creation is concerned. On the bond market here, we are looking at the buying treasury bills, treasury bonds, infrastructure bonds. Of course, if you already invest in treasury bonds, you probably know that your bonds have been pricing, values have been coming down. And this is because of what I was talking about earlier, rising interest rates in the market. If you have not gotten to the bonds market, then this is the time to start picking very good bonds, because you can get bonds that are now paying returns of above 12% generally. And those can make very good anchors to your portfolio, because they'll give you a predictable return. That return will come like clockwork every 12 months. And you don't have to think so much about valuation, because if you get into, for example, a 5 or 7 year bond that has a coupon above 12%, then most likely the valuation, the valuation volatility will be way lower. So something to start thinking about, picking those opportunities as they happen. But of course, be conscious about inflation. We have to be very conscious about that. And then you also have to, if you can't go for a bond directly, then why don't you look for it in the form of a bond fund or funds that are being issued by the market players to actually give you that exposure in small bits. In terms of short-term markets, then I think these are things that you probably interact with: fixed deposits, savings accounts, treasury bills, money market funds. Those are good investments. And this is, for me, if, for example, I wanted to start a business this year, and I decided I can't start this business here until I see how the election starts, or rather how the election play out, I'll put that money in a short-term investment. It could be a money market fund, it could be a treasury bill, it could be a fixed deposit, and then let that season come, let that season pass, and then I can take my money out. What we are trying to do here is to make sure that despite the money not being too in a risky investment, you can pull it out when you're ready. It's earning something and somewhat moderating the inflationary effect on your money. So the purchasing power that I was talking about earlier that we are losing every so often will be way moderated if, for example, in a money market fund that's earning 8% per annum. It may not cover off inflation as a whole, but it's certainly better than having that money sitting idle in a bank account. So things to think about. Things like cryptocurrencies and all those kind of things, I think what I'm telling people at this point in time is just be measured in the way you approach these things. They may sound exciting because of the returns that they've made over the last couple of years, but I think the space we are getting into, it's also becoming quite dicey because of rapid innovation, changes in the mindset of regulators. So central banks are starting to regulate cryptocurrencies, or looking to regulate cryptocurrencies. Regulators are looking at developing their own digital currencies locally. So the space that we were all believing that cryptocurrency will come to play is actually a space that's being disturbed every so often. And I'm not saying it will change the fortunes of cryptocurrencies, but at this point in time, I'll probably be more calculated, for example, before I decide to take a position in a crypto. I mean, think about it. So should I be buying Ethereum today? Should I be buying a meme coin? It's a very important decision because the usability of each of these cryptocurrencies is changing every so often, and new ones are coming every so often. So I might buy one thinking it's going to give me the golden opportunity, but it may not necessarily lay the eggs that I'm hoping it lays, just because of the rapidly changing environment. So something to think about, something to, and you probably have to think whether you're doing it as a speculator or actually because you really believe that that's the next best opportunity. I talked about commodities. It's time to actually think about commodities, either at the production level. We in Kenya can go agricultural. We want to get into the production level, or actually the trading level. Can I get into commodities trading? Which commodity do I want to go for, and how do I get into that space? I think in the next 3 to 5 years, this will probably be a place everyone wants to be playing. If especially so you can actually create the right value chain that takes you to the markets that really demand these. The potential to actually create wealth out of commodities in the next 5 years is actually enormous. And so something to actually want to put at the back of our minds. As I come towards the end of the presentation, then another question you'll be asking yourself is, so after all that is said and done, how then should I actually create my assets to actually put me in the right path? Remember, I started by saying we need to focus on the long-term goals. So once I set my goal, and that's in the long term, what that goal will tell me, I need to attain a particular rate of return on my investment to meet that long-term goal. And I need to manage my risk in such a way that one, hello, can anyone hear me?
We lost you for a moment.
We lost you for a moment.
Yeah, I noticed my internet fluctuated. I don't know how far back I fell off. The last item I was talking about is, had I started talking about the current slide, portfolio diversification?
Yeah, you had started on that before you
Okay, great. My apologies about that. So the idea here is to make sure that you have the right level of risk and the return coming from your investment is actually, a return that's predictable to meet that long-term objective. And so how can I go about layering my investment so that at the end of the day, I'm achieving my objectives? So what I've tried to present here is a generic way of thinking about it. A generic way of thinking about here will be at the apex of this triangle, or pyramid as you may call it, we want to have all our liquid assets. Our liquid assets will be those assets that we know may be utilized in a space of about 12 months, or if you want to stretch it, a space of 18 months. So that could be the school fees for my kids. That could be the money I set aside to start a business that I've been delaying, but I want to do it after the election. Now, generally, unless you have a bigger plan, these monies will be anywhere between 5% and 15% of your investable assets. It could be funded from, for example, your regular income and all that, but it's good to have this money sitting there. It comes to meet your rainy day issues. Remember, we've been told time and again, put about 6 months of, your monthly spending in a rainy day reserve. So up to 15% of your money should be sitting in what we call liquid assets. These are the money market funds I was talking about earlier, the fixed and savings deposits and treasury bills. That is the money, it's earning you something. It may not necessarily beat inflation. It cannot make you rich, but that's money that can be reached. Should someone fall sick, should something happen that changes, your fortunes. So for example, if for example, I went to NCB and they say from next month, unfortunately, Paul, you're redundant, then that's the money I reached for to take me through the next period of 6 months before I get in the next job. The next layer of assets is actually what we call the earning assets. Earning assets are those assets that I like calling them stabilizers. These are assets that give you a return that is above inflation, all your cost of funds, but the return is actually predictable. So for example, I was talking about retirement earlier. I need to have assets that I know for sure. If what I need to, the income I need at retirement is 100,000, for example, I need to have at least assets that can give me 70% of that money predictably. So I'll be looking for investments like bonds investments that I know every 6 months will give me a specific amount of money, and that amount of money will be reinvested at the same rate of return to continue to keep me on that trend of making that return. I call them them earning assets. And that would be somewhere between 30% and 50% of your money. So they will be linked to a particular goal, which could be retirement in my case, for example. For you, it could be school, it could be whatever the goal will be. And they will give you a predictable rate of return, and that rate of return beats inflation. So for example, our inflation is now between, I think maximum we targeted up to about 7.5%. So these investments by nature should be earning a return above 7.5%. Treasury bonds, the Kenyan markets are offering this good rate of return. I think someone who watches the market will probably notice, like just yesterday or 2 days ago, we closed a treasury bond that's earning a return of 12.9% without taxes. If inflation is at 6%, this is earning 12.95%. You're actually making good money and a very predictable amount of money. That bond will be, persist for another 19 years. For me, that could be a retirement bond. For you, it could be meet another objective 19 years down the line. You can do corporate bonds. I think someone could as well have seen KMRC, for example, did a bond, 12.5%. That bond will be a 5-year bond. It's amortizing, so a portion of your money will be paid every year. Very good investment opportunities are beating inflation. For people who want to go private lending, that's another opportunity that talks about commercial papers market and lending in a more formalized way. Then after you've done your earning assets, then the next item is to go for growth assets. Growth assets are the assets that really enhances your return. And this is why you think about taking risk. The risk I'm taking here could be the business that I like. It could be the stock market. It could be that venture that I want to do with a friend. It could be that next big thing that I actually believe can take me to that level. And this is where real research plays the most important role, because you need to ensure that you understand the opportunity, you understand the risk, and you actually understand where the payoffs are. So this way you'll get real capital gains, you'll enhance your return, you'll probably realize the tax that you're paying out of it is not that high, or vis-a-vis the kind of return you're making. So this is where I'll say 40 to 60% or 50%, for example, if you're young enough, should be going. Of course, as you get older, that proportion reduces and you start piling more money into the earning assets. So look at local and offshore stock markets. You can look at real estate. You can look at alternative assets. You can look at your business and side hustle. That's where you park a lot of that money. I mean, the difference between those of us who are in employment and those who are in entrepreneurship, this is where the real difference comes, because they take the risk and make a huge rate of return. But for you, then you always have to make sure that you also cushion yourself. Should that hustle not go right, then you're cushioning yourself with the rest of the earning assets. The last category here is what we call speculatives. Speculatives are, are not an asset class to me, but just comes here to actually, assuage or rather keep the human nature alive. Because there's that opportunity that you probably don't believe in, but you believe it has opportunity, a growth potential. And for some people, I say this is where Rotary money go. I have put 0% allocation because I don't think it should be a strategic conversation that you're having about going speculative. And then for you to ask yourself, is it really necessary to go for these speculative assets? So I was talking about Bitcoins earlier, for example, or rather cryptocurrencies earlier. Am I going to this as an investment, or I actually want to speculate? If I want to put money there, then I'm putting money that I know I can actually lose 100%. So maximum 5% I want of my assets should go to this, this category. So you may want to do research, or because it's speculative, you just want to follow the herd, but keep it to a level that even if it went bust, then you actually are not at a major risk of losing your hard-earned money because of being in that category. So team and everyone, if you follow this kind of script, and I think I've seen it working with my clients, I've tried to practice it on my own, not to a lot of success, but at least I've started the journey. But I realize I get more comfort because I can tell every need is actually catered for. My long-term needs are taken care of, my short-term needs are taken care of, and I'm almost in a predictable journey. So that if I'm saying I need a rate of return of 10% to get me to my retirement date, I can tell with relative certainty that I'm actually hitting a return of 13%. So my growth assets have to give me that additional return, or probably enhance it above that. That's the journey that I would encourage all of us to start taking as far as investing is concerned. Stay diversified, and that will save your wealth. That's it today for the presentation. I'll hand it over back to you.
All right. Wow. I think I'm personally just trying to wrap my mind around everything that we just talked about. And that was quite insightful, to be very honest, especially on my end. I've really picked out a lot of details that are quite relevant as to where I'm at right now. And I know it's the same for every other person within the webinar. And I think because our time is much spent, I'll just dive in right into the questions. I have a couple of questions that we have, and I'm pretty sure this will be able to cover us for the remaining portion of time that we do have. And I think the first one, jumping back to the investor's mindset, I think I have two key questions. And the first one is, what do I need to be alert on that might affect my portfolio? Or rather, what do I need to be alert on that has an effect on my portfolio that I need to be cognizant about as an investor? Let's say, for example, you've mentioned something like interest rates. How does interest rate affect? What are the other factors alongside interest rate that I need to have in perspective, that I know when I see that the market is getting a bit alert towards some certain issues, be it, let's say, political and geopolitical tensions like Ukraine and Russia, which are the other things that I need to be aware about, that even when I watch the news or just put my ears across to what it is that's going on in the market, that I know that this has a potential to affect my portfolio in a positive way or in a negative way.
Thanks, Teddy. I think you've already half answered that question. So the most important items that I think one actually need to be watching at this point in time is, one, the word inflation. I think it's impacting almost every single investment that you can be thinking about. Inflation is impacting commodities pricing and the commodities return. Inflation is affecting, interest rate assets, treasury bills, treasury bonds, and all that kind of those kind of assets. It's investing stocks that you're investing in. So generally, we are told go for stocks because stocks and real estate because you can manage. They help you manage inflation. But unfortunately, look at real estate. The way you manage inflation through real estate is actually passing on the inflation to your tenants. Unfortunately, look at Kenya. How much can you pass on that inflation to anyone? I mean, it's now a tenant's market more than it used to be a landlord market. So you don't have that much space. So inflation is a very critical item to think about at this point in time and how it affects anything you are doing. Then the other item I'll say is the currency direction. Now, as much as currency doesn't play out, currency actually influences inflation. For us, for example, in the local market, we have a lot of imported inflation in Kenya. Remember, our main import bill is actually oil. We have having a double whammy here. So we're having rising oil prices. You're probably seeing in the 90s now, up from 70 just the other day. And then we are having a losing currency. So generally, what will happen, commodity prices or other prices of anything in this country will be impacted. And unfortunately, that will manifest in interest rates, will manifest in anything that you touch. So that's something that one always have to be watching very cautiously and very closely, and trying to interpret how exactly it impacts your investment, be it a business, be it a financial investment. And of course, the other important item I think lately is regulation. Regulation is changing every so often, globally and locally. So, I mean, let's watch the actions of our parliamentarians, because sometimes they'll make decisions that are not necessarily, aligned to, economic success. But it's something that you have to be conscious about. We're now getting into a regime change. I think about it. Regime change will come with, either exciting pronouncements, changing regulations, or let's change this, let's change that. That space is actually changing very fast. So those are probably the three important items I'll say everyone needs to be conscious about when you are thinking about your investment or a new investment you want to make. Thank you.
Wow, that's amazing. And also building up on that, we also got to talk about risk. And I think something that I've personally learned today is the aspect that risk averse, that it isn't really a bad thing, but you're not supposed to fear risk in the same manner, And then I think a question that came with that is then how can an investor increase their risk appetite? Because by default, even when we look at the pyramid you shared, we might find that most of us might tend to gravitate towards liquid asset classes, the money markets and the treasury bills and the treasury bonds, of which you tend to see that each and every week you tend to find oversubscriptions on the 182-day and the 364-day papers. So how can an investor increase their risk appetite in order to access the other investment opportunities that exist in high risk assets?
Good. I think probably the best way to look at it is to be deliberate first on asset allocation. I think you have to be very deliberate. If you're deliberate, then you'll know for sure out of your pyramid or triangle, whichever you look at it, then there's a missing gap that you're not filling. If you keep going for treasury bills and going for treasury bills and going for treasury bills or money markets, then there's a gap that will always suffer. And most likely what will be suffering is what we're calling the growth assets. Growth assets, to do that, you certainly have to start accepting an element of risk. Now, once you are that deliberate, then you start researching where can I pick the right kind of risk combination that implies picking up more returns. So some of us will decide, the only way I can do that, because I can't trust my decision-making capacity, is to go to someone who is offering me an equity fund, for example. That person will pick those assets for me. If I have stronger belief in myself, I'll actually say, okay, you know what? I believe I can do good research on the stock market. Let me go and pick some stocks for myself, but go diversified as you go to the stock market. So you are doing it deliberately, and you are saying, I'm going in this direction. The rest of us will actually say, you know what? I don't trust this stock market, either because of regulation or because of the shenanigans that have happened in the past, but I want to go for a business. Do the right kind of research. Enter into the right kind of partnerships. be in the right kind of company. With that, then you can start appreciating and increasing your willingness to actually take that risk. Of course, so far as you stay within the pyramid and you allocate the right amount of money to the right pyramid, even if that risk goes bust, you take it as a lesson and move on to the next best opportunity. That's how to respond to that question, Teddy.
Awesome. And also building up on that thought process, we've really talked about one major thing that I'm pretty sure everyone has noticed today, which is research, and we started off by, you have to do your own homework, you have to do your own research. There are fund managers, asset managers who get to do that research for you as well. But the question that I have is, for someone who's looking towards growing as an active investor, is there a framework on how I'm supposed to approach investment research as an investor?
Good, and that's a really good question. Now, investment research is, I mean, by the way, it's sometimes we in that space make it sound like a complicated thing. It's not necessarily a complicated thing.
Definitely.
It's probably just adopting a thought process. No? Yeah. Now, investment research starts in two ways. And there's an approach we call top-down research, and another approach we call bottom-up research. Sorry to use that term. I think it might be a very tricky time to use that term. But anyway,
polarizing statement.
It is an approach to doing research called bottom-up. So, top-down approach means, so let's say I want to invest in which one do I take? Let me just take East African breweries.
Yeah.
If I start with invest in East African breweries, then I'll ask myself, what actually drives East African breweries business? East African breweries business is driven by consumption of their product. What drives the consumption of their product? It is the purchasing power and the growing middle class, for example. How does the middle class grow? The middle class grows because the economy is expanding, opportunities are rising. So for me, then if I'm doing a top-down approach, I'll start by understanding what direction is the economy taking as far as expansion is concerned. Are we in a contracting economy? Are we in a, an expanding economy? So I give myself comfort at that level first. Then I'll ask, if you're in an expanding economy, how does that impact the middle class? And I mean, as much as I'm talking about the middle class, I think EABLs could also be affected by other factors, because there's also a rising and increasing youthful age that, lifestyle then becomes another consideration. So, but just give an example. So how does that impact the middle class and the youth, for example? Are they able to actually consume what I was calling consumer discretionary products, which, things like what EABL produces could be called consumer discretionary? If they're able to afford that, how do they allocate their spending? Are they likely to lean towards an EABL product, or are they likely to turn to alternatives, all, as we call them, imported stocks? Once I understand that, then I narrow down to now understanding EABL. That's top down. I was started from the factors that affect the economy, the consumer, the company, and then now look at the company in more detail. So when I look at the company, I'll be looking at it. What are they producing? How efficient is their production process? How are they financed? Is the cost of financing too high? And all that. When I put all that together, then I'm able to make a decision whether EABL is a good investment to have. Now, the other alternative would be the bottom up, where if just taking an example of, I don't know which example to take. Let me take a company like BAT. BAT has no meaningful competition as far as their space is concerned, if we agree to it. So I can actually say, I'm going to focus on BAT to understand BAT as an entity and how they have internal efficiencies as far as, production is concerned, so that then I'm actually to try to see how profitable they can actually become. Because, of course, as much as we are talking about, illegal imports and all that, the market is still dominated by them. So as much as that has an impact, they'll still continue commanding a meaningful portion of the market. So I can actually just narrow down my research, just BAT, and keep it at that. So the same can be used for any kind of a conversation. If it's a business you're starting, you can decide to go top down, or you can actually start, depending on what niche you're serving, you can decide to keep it at a bottom up level. So bottom start with the entity or the product, and then try to see how does that and then filter up into the overall economy. So if one uses those two kind of approaches, I believe they can actually be able to do meaningful research as far as investments are concerned.
Wow, that makes a lot of sense, and especially not just having one framework, but two frameworks to work with. And again, building up on that point as well, we mentioned about equity funds and mutual funds, and these are potential vehicles for investors who really don't want to venture out towards doing their own research. And there's really not been a huge absorption of such funds in the market. And the first question with regards to that will be, why is that the case, that there are quite few equity funds, quite few bond funds, and leave alone with money market funds, but equity funds and bond funds and even balance funds? Why is there a low uptake within the industry from your experience? And the second question with regards to that is, for someone who's now looking into starting out with the growth assets and the earning assets through these types of funds, what am I supposed to look out for? What am I supposed to look out for with regards to an equity fund or with regards to a bond fund?
Good. So my response to the first question, Teddy, I think the reason that equity funds are not growing as such in Kenya, I think one is an element of information. I think we as market players probably have not done the best in terms of disseminating information, or actually ensure that the market understands the risk-return trade-off of investing in an equity fund. I say that because the same market is willing to go and do a business elsewhere, which is a form of equity investment. So we've not underscored to them what the risk-return trade-off of this segment is, and I think that's certainly a challenge that's coming up, and we're probably seeing more engagement with regulators to actually start giving that information to the market. The second issue about penetration of that space is, I think you alluded to it earlier, when you said most of us are focusing on investing in money markets and short-term investments. Our mindset is risk avoidance, not even risk aversion, it's actually risk avoidance, yes, where we just want to get into very predictable assets. The fact that all of us want to stay in that space and really limits the opportunity or the willingness to actually test what the equity markets or the equity funds are offering. Of course, the other item is that I think over the past, there's been a lot of mis-selling. I think the selling models for most equity funds were wrong in the first instance, because were sold as a sure products as far as returns are concerned, which is not true. And so we've lived with that effect for a while, that people who probably burned then are not willing to come back to the market, and those who are coming in late still don't believe in the story, and you're not giving them the right kind of information. And of course, the other item is the market size. So the underlying stocks that you can actually buy, the market is still very limited. I think unfortunately, and all of us could be aware that our market probably have not more than 8-9 liquid stocks, and so that has also limited the opportunity as far as these markets are concerned. But what we are doing, and is to start diversifying those assets. So starting to go offshore to look for more assets that can actually be parked in that, but to also reduce the Kenyan risk as far as those funds are concerned, and give more opportunities for the market. Mm-hmm. So what to look out for? For me, I'll say, one, who is the manager of these funds? It is important to be sure that it's actually being managed in a manager who believes in proper research, corporate governance, and things are done right. So the structure is very important before you get into any of these equity funds. Two, understand what is on the fact sheets or the offer documents for those equity funds. Follow the fact sheets, ask for the fact sheets. I think equity funds are the type that will say, I invested and I saw the fact sheet once and I'm following them. I want to understand the fact sheet of an equity fund. What the fact sheet does is to tell you where the money is invested, whether the strategy is shifting or drifting back and forth, or whether these people are really committed to the cause. Because we've seen equity funds that say they're equity funds, but they invest 60% in bonds and 40% in equities. We've seen other equity funds that invest 80% in equities and 20% in short-term investments. So it's very important to make sure that you are in an equity fund that you truly understand and can tell the direction. Because if you are convinced that you need to be in equity funds, in equities or stocks, then the fund needs to reflect that conviction. And that's very important to look out for as you start engaging. Of course, the element of cost is also important. Element of service is very important. Those are the things that you always be on the lookout for.
Oh, wow. Okay. Thank you. Thank you so much for that. And again, building up on that thought process, now that we've looked into equity funds, I'd love for us to shift our focus a little bit into bonds. And there's something interesting that I saw that CMA had posted yesterday, which was a summary of how the corporate debt market has been performing for the past 1 year, with the EBL medium-term note program recording a 245% of a subscription, Family Bank the same, and also quite recently the Kenya Mortgage Refinancing Company with 147% of a subscription, and people who are out here even asking, even with regards to the infrastructure bond that was closed, I think last week, but one that had the 12.9% return without interest, without tax rather. And the question that I have is, and for each and every investor over here, the first one being, why the focus towards bonds, especially within the Kenyan market? Is it because they guarantee a great rate of return? Or is there any other underlying factor that you may not be aware about that you as the industry players are well aware about? And the second one is with regards to infrastructure bonds. Maybe there's a question from one of the participants who would love a deeper insight into that. Thank you.
Okay. Yeah, so thank you. Certainly, I think we have a very biased market towards bonds.
Yeah.
I think the main driver towards investing in bonds, and probably starting with the government bonds for a start, is the market is actually not very diversified in terms of offering. And so even if I was looking to diversify my portfolio, the risk return trade-off for anything that I choose to go for is not making sense. So think about it. If you look at, unfortunately, the stock market, for example, the last 4 years, the annualized return over the 4 years on the stock market has actually been beaten by the bond market. I mean, it's actually sad that the bond market's probably returned averagely about 9-10% on a per annum basis, but that still beat the stock market. And so one asks themselves, to what extent should I increase the level of risk I'm taking on the stock market if the bond market in the last 4 years have performed that much, in such a way? But obviously, we are also conscious that there's a seasonality effect as far as this is concerned. The 4 years that we've been going through have actually been, pretty peculiar for us. I think COVID and then the global movements and all those kind of things have actually affected the return, especially for the for the stock market. So that has been the main driver for people to focus on that. So imagine then now linking to the earlier question, you're in a market where people are actually avoiding risk. There are no alternatives as far as investments are concerned, or no meaningful or no major or not good supply of alternative investments. Information is not being relayed the right way for people to actually be able to make those decisions. Then everyone then ends up heading towards infrastructure bonds or taxable bonds. And you'll also notice that in the same 4 years, for example, there's been a real avoidance of corporate bonds, because it's also in that same 4 years period that some bonds actually went bust. I mean, from 2015, we had a series of issues. You remember Chase, Imperial, Real People, a number of commercial papers went bust. So all of us then realized, okay, the risk return trade-off for buying these papers is not, it's not making sense. And so that market has actually been avoided, for that long period of time. And because again, the same period that we are talking about, the government borrowing has been rising, the rate of return has actually been rising on these treasury bonds. And so it made a lot of sense to actually go for them. And the market was ripe for it, because then the rest of the world didn't have a good return. So foreigners are still coming for infrastructure bonds, then ensuring that bond prices are actually sticky to some extent, and the likelihood of loss from a valuation perspective was very low. That dynamic is now changing because of the rising interest rates. And so the bonds that have been preserving value that much have actually started losing value. I think if you look at what has happened in the last 2 months, the bonds market has actually lost almost 2.5% in terms of valuation. And so that trend is changing. Coincidentally, then that has also come with, good issues as far as our corporate bonds markets are concerned. So we've seen, EABL, Family Bank, we just saw KMRC, good quality bonds. And so that's bringing a new wave of confidence in corporate bonds. Now, because corporate bonds are generally about 5 years, then people don't need to trade them much. And so the need for price discovery has not been so much as far as those bonds are concerned. People are willing to hold them to maturity. And so becoming another safer place to hold these assets. The focus on infrastructure bonds is purely a tax conversation and liquidity conversations. They are way more liquid because the demand, goes beyond, the local tax individual. The foreigners are actually coming to buy them for the tax advantage. And the coupons on them have also been very good. So if you match the good coupon and the high liquidity in terms of resaleability, that has always boosted demand. So those are the main drivers that have actually been driving the market, a market for bonds. Yeah.
Right, and in addition to that as well, with regards to bond, you've mentioned that there has been that sentiment with regards to embracing, like holding their bonds to maturity. And the question that I have, and I know that someone over here has, is now for me who, let's say, for example, missed out on the reopening, let's say, for example, the reopening of the infrastructure bond for the past 2 weeks, how can I be able to access these opportunities in the secondary market, and how does the secondary bond market work? That if I want, let's say, for example, to enter into a position of the 7-year bond, how can I do that?
Good. Great. We have a fairly liquid secondary market. I use the word fairly because, of course, in the current trend, you can see the market dancing and forth. I would actually say at this point in time, it's actually a buyer's bond market, because as I say, the prices have been adjusting downwards. To get a bond, it's not very hard to get a bond in the secondary market. Actually, you just need to work with your broker and say, I'm looking for a bond of a particular tenor, and maybe specify the level of coupons or the minimum coupons that you're looking for. Then the broker will actually show you what's available in the market. Collectively, then you can make a decision to buy onto that bond. And then, if you have a CDS account, that will be bought. Of course, if you don't have a CDS account, then we also offer those opportunities for you to buy on a platform that's offered by a bank. The only challenge with the platforms is that they probably may specify minimum investment. So, for example, our platform says a minimum of 1 billion shillings invested in bonds. But if you have your own CDS account, you can actually go for low amounts, as low as 50,000 shillings. So those bonds can actually be available on the stock markets. Of course, the lower amounts, probably the prices are not the most favorable when you're looking for very low amounts, but they still give entry opportunities either way. And that can be done through any stockbroker of choice if you have a CDS account.
Wow. Okay. All right. Thank you so much. Just for the audience and the participants who are here with us, if you have a question, remember to ask. Yeah, we are about to come to an end of our session today. So if you do have a question, please let us know so that we might get to tackle it before we end the session. I think moving on to the next portion, Mr. Paul, is with regards to diversification. And you've really talked extensively about the asset allocation pyramid. And I have a question that I'll ask it in 3 ways. Let's say, for example, I'd like for us to, for example, create a profile. And let's say for a 25-year-old young adult who's just starting out, let's say they've gotten their first or second job that's becoming quite stable with regards to income, what are they supposed to consider, and how are they supposed to approach the asset allocation pyramid, and where should they place their positions? And how can the same be replicated to, let's say, for example, a 35-year-old person who's having a stable family, a young stable family, getting into responsibilities like school fees, like retirement, building up their career or their businesses? How can they look at the diversification pyramid? And then also for someone who's like in their late 40s, early 50s, late 50s, how can they approach their diversification requirements? Thanks.
Good. So of the 3 age sets you've specified, the the luckiest person is the person at the age of 25, if they're starting to make these decisions. Because the person at 40, the person at 35 probably have lost, up to 10 years of, well, up to 15 years, actually, if you are 40, of actually starting the journey, if you have not already started. So for a person at 25, this is how I look at it. First, draw that allocation based on an objective. Create an objective, whichever objective you create. Draw that allocation. But because then the main source of investment will actually be maybe what you are saving from your income, or from your employment income, then this is what I'll tell you. I'll suggest that you actually consciously working at saving up to 30 or about 30% of your income. Now, if you start saving 30% of your income, for you, I'll say I'll start with the apex of the triangle. And so at the start of the apex, what I'll do, I'll first create an adequate amount that can meet my immediate liquidity needs. And so for you, the first item is to create your 6 months of contingency balances. Create that and put it in a place that you're saying, okay, this one is actually earning something. Then after you're done with that, because I'm assuming here you don't have major responsibilities, be it school fees, be it the main expenses probably entertainment, food, rent, commute, and all those kind of things. So those are taken care by your 70% that I said you can spend. Yeah, this 30% will build the first level to the highest extent possible, and then as soon as you've actually achieved your 6 months of contingent balances, start looking at earning assets. Build those earning assets as you start the research of your growth assets. So what I'll be saying, for example, and I mean, of course, it will depend on how much one is earning. So for example, if my contingent balance or the emergency reserve is 500,000 shillings, I'll build that. When I move to beyond 500,000 shillings, then I start building my earning assets. And my earning assets, because as you can imagine, proportionality, if 10% of my, let's say I'm using 10% here as a liquid asset. If 10% is 500,000, then 50% or 40% actually needs to be something like 2 million shillings. So I'll start building the next layer to the extent of building 2 million shillings in earning assets. Yeah. When I'm done with that 2 million shillings, then I'll start saying, okay, I've been researching on my next hustle or my growth assets. How much money do I need to put aside for that? Then I create that pool. Now, as soon as I've done creating that, the first layer of my growth assets, then you actually realize your age is moving and your responsibilities are increasing, and they need to start creating an additional layer of liquidity reserves because kids will start showing up soon. Then becomes more important. So then you you repeat the iteration again, so that then you increase the amount of liquid assets, increase the amount of growth assets, earning assets, and increase the amount of growth assets. If you can iterate that and repeat it for a period of 10 years, then your path becomes very predictable. And so from there, then you probably have a way of deciding, today I'll deal with growth, tomorrow I'll deal with this. It becomes a predictable path. If you're 35 years old, of course, your liquid assets may probably be higher. So you are the urgency to, and the same for 40 years. The urgency for liquid assets becomes higher. The urgency for things like education insurances become higher. And so the journey may be somewhat different. And that journey could be achieved in two ways. You could actually save upwards or save downwards. So saving downwards here is go to a bank, borrow a loan, achieve a particular objective so far as the cost of funds is making sense, and then start repaying that loan. It shortens the journey to actually doing some things rather than waiting for so long before that can be done. So I'm talking about, for example, here buying a house. I mean, if you're starting at 35, you may not be able to say, I'm going to save to buy a house. You might as well go and approach KMLC, approach a bank, and start buy that house and pay it over time. Whatever additional reserves that you're getting out of remaining balance that you're getting out of that, you start creating your other earning assets or your growth assets. But for you, the most liquid assets are more urgent. A combination of top-down or saving down or saving upwards is very important to actually help you start that journey. I hope that helps.
Yeah, that definitely helps. And I think I'll jump on to the last question, unless there's any question from the audience. And the last question will be with regards to investment groups, or commonly known as chamas and financial markets. And I think for the past couple of years, it's been a very interesting trend, considering how these groups are in existence, but you might not really feel the effects in the financial markets. And from your position as an investment manager, what have you noticed to be the trend with regards to these groups? What have you seen to be the challenges that these groups face and encounter with regards to accessing financial markets? And how do what are the potential solutions on how to counter the challenges that they face?
Good. Thank you, Teddy. Investment groups, or chamas, as we like calling them, is an evolving space. I think this space has evolved from the traditional merry-go-round, traditional table bank, traditional land buying companies, because I think that's what they typically have been.
Yeah.
To now starting to think, what else can we look at? And what I like about that is that we are starting to get ourselves out of the same risk setup kind of setting. Because I mean, I always wondered, why did I have to belong to 5 different chamas to buy land? And what will happen is that all those chamas, unfortunately, because they're depending on me, I'll tell them, let's go and buy land at Kamuru. So at the end of the day, I've taken all my savings and pushed all that money to Kamuru. I mean, I'm not saying Kamuru may not pick up, but if it doesn't pick up, then I'm all exposed.
Yeah.
So and then of course the notion of merry-go-rounds have actually been challenged time and again. It's not a bad notion, but it feels to me more of a welfare conversation than actual an investment conversation. Table banking for the purpose of lending to members, I think we all know it has opportunities and its own challenges. So I mean, some chamas have gone bust because of that. Because unfortunately with that, they never even created the right lending infrastructure. And so someone picks money, you end up make a mistake of lending them 50% of the money, they're not able to pay or decide they're not paying. And unfortunately, because of how informal we have been, or the structures are, how loose the structures have been, then we lose the money and move on. So what is happening lately is that I've actually seen increasing inquiries from chamas for investment advice. And investment
So you're breaking up a bit.
Sorry, can you hear me now?
Yes, you're back. We missed you a bit. We left you at chamas
So
looking for investment advice.
Yeah, so they're now seeking investment advice, and we are providing advice. And what you're telling chamas is actually to ensure that they scope their objective very well and in time. And then once they have that objective, then it's better to advise when you know what is the direction of this chama. If this chama wants to be a welfare chama, then put your money in money market fund, and let the welfare objective happen from there. And I think there are those that have chosen to take that direction. If it's a growth chama, then we are challenging each of us to then think about how they want that growth to be, to be achieved. That growth ideally should be achieved in a diversified format, so that you're actually saying, I'm actually getting a return that's predictable and that meets the objective, the appetite, the risk appetite for that group. Because what I've realized with Chama is that if there's one very outgoing and outspoken person, they end up influencing the investment strategy that can lead them to a particular risk, risk framework. But if the Chama decides, let's create our own investment policy that they all discuss and agree, then it becomes very easy to actually pick alternative investments. And I think that's what I'm encouraging everyone that I speak to in Chamas, create your own investment policy statement, agree on it as a membership, commit to it, and then from there start looking for investments that then speak to the investment policy. And then obviously every quarter, because monthly may be too much, review and decide, are we within the policy? What do we need to do? Do we need to recalibrate? And how do we need to move? Where then you need advice from an outsider, I think this advice is becoming free and cheap. I think for some of us, it's actually a thing that we want to do for the purpose of, growing our chamas. So we are happy to keep talking about these things. If you cannot get the IPS investment policy statement right, we're happy to actually start, guiding you in the right direction so that eventually you can actually decide, or rather create one that makes sense for that chama. I think that's how I would look at it. Avoid groupthink, be objective, and document what direction you're actually going, you're seeking for that group.
All right. Wow. Thank you so much. Thank you so much for that insight. And I think just a cherry on the top, a bonus question will be with regards to, there's something you mentioned about knowledge and understanding all these investment products and all. And I think the final question that I have for today is for each and every participant in here, what is the advantage of growing in financial literacy and financial education? And even diving deeper into that question, I would ask, what benefit or what upper edge does it give you with regards to accessing these different opportunities?
Very good. And my answer could be very biased because I'm already in the space. But I'll say, I think financial literacy is actually now a life skill, to be honest. It's as good as knowing how to manage stress. It's as good as knowing how to manage work-life balance. Financial literacy is a skill that you cannot survive without. I think be it the business that you're running, I think the interlinkages of how the economies play, how it affects your business, how it affects your risk is a very important thing. So whatever decisions that you'll be making as far as your wealth is concerned, as far as your lifetime goals are concerned, will need some bit of financial awareness. That's very important. And it enriches the kind of decisions that you make as far as investing is concerned. It enriches your lifestyle. It enriches the people that that you're living with. And it reduces this general dependence that we've had. I think we've had a general dependence of, I am Teddy's insurance as far as his issues are concerned, and he's my insurance. And if I don't chip in, he gets very offended. I think those are the things that are coming with an element of a financial literacy as far as the society is concerned. And I think there are things that we're actually trying to, as people in this space, to actually dissuade the society, telling people that there's actually a different way of looking at these things. You don't have to wait for an eventuality to happen to actually run to your people to actually get things to happen. And that's why I think, thinking about your health insurance, thinking about your medical insurance, thinking about your kids' education insurance, thinking about your retirement, thinking about your rainy day reserves are becoming part of conversations that you cannot avoid at any point in time. So whatever decisions we'll make with a level of financial literacy, then you'll actually be able to make them from a more informed perspective. I don't think you have to go to a class, to be honest, to be financial literate. I think there's a whole of sources of information that you can actually use. Nowadays, every time I get into any podcast, I mean, you just go to a podcast and you can get people talking very good, giving you very good snippets about financial literacy. You go to any bank website, you get financial literacy. You get to anything that you interact with, social media. There is enough groups that you can actually join that give you free financial literacy classes. And of course, opportunities like this to learn and to actually, put things into context. So Teddy, I'll say the reason I'll advocate for it is actually a life skill. Thank you.
All right. Thank you so much, Mr. Paul. This has been a very insightful session. I have personally learned a lot, and I'm pretty certain for each and every person who's managed to join us today, that has been the same sentiments for them as well. And I just love to say a vote of thanks. Thank you for making time. You have talked about so many things that have just given us at least something to continue chewing upon and just building our knowledge and understanding upon, which is actually the most important thing. And even as we come to an end, I hope that this webinar has been of value to each and every person who has been a part of it. I hope you have picked something, and all that matters the most is that having received knowledge, understanding comes by putting it into practice. Yeah, and wisdom comes by knowing which are the right tools to implement at which certain time. So thank you so much for each and everyone who's joined us. Thank you, Mr. Zeph, for granting us the platform and the opportunity to have this webinar, and much more appreciation to you, Mr. Paul Gicheru, for your wonderful insights and time to share with us and help empower our generation financially. We really appreciate. That's it from my end. My name is Teddy Mudhaka once again, and we'll see you next time. Let us know if you need another webinar with regards to investments, any other particular topic, any specific topic you'd like for us to cover. Be sure to reach us out on our social media platforms at Mantalk Worldwide, or our individual profiles on Facebook and LinkedIn. Thank you so much, and we will see you next time. Take care.
Thank you.